Good morning viewers and welcome to the channel. My name is Shannon Rifkin and in this week's video I'll be discussing Westpac. Heading here, Westpac disappoints the market with its FY21 earnings result. I'll go straight through to the chart actually on Westpac since the beginning of 2020, which is pre-COVID, and shows it's a pretty good summary of the journey that bank shareholders have been on. Certainly as COVID hit and there was some pretty dire expectations on how the economy and certainly the bank's profit and loss and balance sheet would look before we started to get a better idea on how this pandemic was going to be shaped, and then of course we saw very successful vaccine results, and then subsequently into what I'd consider a pretty significant property boom, which ultimately saw both significant loan growth for all the banks as well as a reduction in bad debts as the worst of the pandemic never really eventuated, and this is really the first and only speed bump we've seen since those early COVID days. So what's caused this? There's no doubt that the banks are all in a bit of a sweet spot here. As I said, property market has been very, very strong. Activity has been very high. Loan growth in the sector has been very strong. Yes, of course, we've had very low interest rates, which has had an impact on the bank's net interest margins. But with increasing inflation and the likelihood that we will see higher interest rates in coming years, the market's starting to price in the fact that the banks are going to see higher net interest margins. So on a revenue basis, there's no doubt that things are pretty positive for the business, for all the banks. So what happened with Westpac is very much not to do with revenue, and they've made it clear that that they will spend to continue to ensure that their market share remains at least steady, while the environment remains so strong. But it's all about the cost situation for Westpac. Obviously, they had a little bit of a speed bump with the anti-money laundering regulator, a watchdog, and part of that, for example, is the fact that they've had to hire 3,000 new staff over the past year to help with setting up new financial crime and complaints handling procedures. Other new costs that have come into the business, making it pretty unlikely in our view, and certainly the market's view, that this long-term goal here of $8 billion in cost base is going to be met. And this was a big part of the story for Westpac, getting it down from its current high levels, and this is going to be 13.3 billion, down to 8 billion. CFO talking through the result the other day said the path to $8 billion is pretty clear, but a lot of the new costs that have come into the business look very much ongoing and pretty hard to cut from the cost base just as easily as they say. So while the revenue side of the business looks very strong, the bad debt part of the business looks really positive. Without this cost out part of the business, Westpac's going to find it very hard to meet its, at least the expectations of many analysts out there, considering Westpac had been guiding towards that $8 billion. And of course, with high costs and lower profits, that's going to hit the dividends over that time as well. So, it's pretty clear why the market got a little bit nervous about Westpac. Now, the question is this going to spread to the other banks, or is this a Westpac specific issue? I guess we're going to see. The banks sold off a little bit on this announcement, but certainly Westpac took the brunt of the selling. So at least at this point, it does feel like this is being seen as a Westpac specific issue. So I wouldn't be too nervous yet, but it does show quite simply that growing in this sort of environment brings its headaches as well. It's not all smooth sailing, and Westpac's obviously met that pretty savagely with its most recent update. Anyway, that's it for this week's video. Thanks for tuning in. I'll be back with a new video next week.